My name is Jasmine. I'm the head of the marketing department at American IRA, and we are so happy to have Reed Myers from Myers Capital as our special guest today. I do have to say that just because we're giving Reed a platform to present in the webinar does not mean that American IRA endorses or supports Reed Myers or Myers Capital. Should you want to participate in any business or investment decisions or any information you hear on today's webinar, please do your own due diligence. American IRA are not fiduciaries. I am not an advisor. I cannot tell you what to do with your money or your business or your investments. You need to take that upon yourself to do your own due diligence to make that decision. Consult your CPA. Basically, the only thing that I can say.
My name is Reed Myers. I'm the principal fund manager of Myers Capital, as well as Myers Investment Group. Myers Capital is a family-owned company, been around since 1998. We're second generation. My father started it in South Carolina, and then I ended up kind of getting into the business later on, and eventually he retired. I took over the company and moved back to Hawaii. People always ask, what are you doing in Hawaii? So I was born in Hawaii originally, but grew up in the Carolinas. So I ended up moving back to Hawaii and opened up a branch out here. Basically just still operate our lending side of our business nationally, all from Hawaii. So what we do as a company, we lend out money. We're a mortgage company, so we work with borrowers, sometimes consumers. That's only in Hawaii, but we also work with real estate investors. These are people looking to, acquire, build their portfolio, maybe some light development, things like that. And that's primarily what we're going to be talking about today, is how to participate from a capital investment standpoint. So again, different from real estate investment, how to participate in these types of deals to hopefully give you what you might be looking for as far as your investment thesis, your investment strategy.
I did not know that you were pretty local to the Carolinas. That's a very interesting fact that I learned today.
Right. Because you folks are in North Carolina?
Yeah, we're based in Asheville. We're the only self-directed IRA company in North or South Carolina.
Great.
Well, other companies work in the Carolinas, but we're the only one based in the Carolinas. So,
Right.
yeah,
Yeah,
downtown
I thought
Asheville.
that yeah, our first branch was in Greenville, South Carolina.
Oh, yeah, right around the corner.
Yeah. And that was basically where I grew up. So we've had branches. That was our original location in Greenville, South Carolina. And then we've had a branch in Richmond, Virginia, and then of course Hawaii. But nowadays the rules of business have changed quite a bit, and we don't need to really have our physical brick and mortar anymore other than Hawaii. So we've got our office here in Hawaii, but we do business all over the US, all from Hawaii. So
Oh, that sounds lovely. That is very, very nice. We do still have a physical office that clients can walk into. There are some aspects of what we do that require people to be able to come in, deliver checks, that kind of thing. But yeah, we're nationwide too, but I wish I could work out of Hawaii. That's that would be lovely.
yeah, it's a great place. So passive mortgage investing, like we talked about, this is our company, our management company is Myers Investment Group. I'm the owner, and as well as the fund manager, and of course the owner of Myers Capital, where we do actually all the lending. So we'll just talk briefly. I mean, I'd be more than happy to share this with you folks. I don't want to spend too much time just reading what's on the screen. This is meant for you to kind of go over in your own time. So any other questions, just feel free to let me know. But the main thing with passive mortgage investing, I mean, just look at what's happening right now with the stock market. I mean, it's been a wild ride just this past couple of weeks. Last time I checked, I think the Dow was up 2,700 points today. This basically avoids that. It allows you to get in the kind of the catbird seat of controlling your investments in a way that just provides steady double-digit returns. On average, we're average annualized returns to our investors of 10 to 12%. It's secured by real estate. So in my opinion, some of the holy grail, what some investors are really looking for, if you're looking to hit it out of the park, if you're looking to make just incredible yields and take on a tremendous amount of risk, this is not that investment. But it's going to provide stability, and it's backed by real estate. This is the role that most banks want to be in. So anytime you go to a bank and say, can I get a loan? They're going to ask you, what sort of collateral do you have? And that's what we do. We take collateral, and it's all real estate. So we don't get into equipment loans or anything like that. So basically, this is a mortgage. It's backed by a hard asset, which is real estate, and it provides consistency as far as returns, and the returns are very, very strong. So the way it's set up, you would typically get, depending on what you invest, typically get monthly or quarterly distributions. I'll talk about that in a minute. And these are relatively short-term investments. So average term of these loans, it's basically when you participate here, you own a mortgage or a fraction of it, and their typical terms are about 12 months. So it's relatively semi-liquid in that sense. You're not locking up your capital for 5, 7, 10 years as you would in some other types of private investments. So here's an actual deal that we closed. This one was last year. And we had in Hawaii, obviously, most of our lending is done in Hawaii, but we do focus in other geographic areas, mid-Atlantic through the Southeast because of our existing relationships going back to almost 30 years there. We like the Northwest. We stay out of California, Nevada, Arizona, partially to do the competition and licensing requirements. The yields are, in my opinion, what I've seen are a lot lower in California because it's so competitive from a lending standpoint. So those are the main areas. And then we also focus a couple of states in the Sun Belt, primarily New Mexico and Texas. So this is an actual deal we did last year. This is an apartment complex. This is Hawaii. Hawaii has a pretty high price point. Basically, our borrower came to us, who is a real estate broker here in Hawaii, a successful one, and he saw an opportunity to buy this property, which is very low price for an apartment complex in Hawaii. Usually these start at $1 million or $2 million. And there's a reason why this one was actually quite a bit lower. Actually, apartment complexes usually sell for about 2 million or more. But this property was in Honolulu. We lent the client 390,000. The purchase price and the appraised value was 650. It was a 9-unit apartment complex. So this one, our capital investor earned a return 11.19%. And they took the whole note, which is $390,000. And the term on it was 12 months. This is a pretty vanilla loan, as we would call it. It's a first lien position, and we actually had guaranteed interest in here of 12 months. So I'll touch on that in a minute. But basically, that's the return, 11.19%. So this investor wrote a check for $390,000. They own the mortgage. We facilitated everything, obviously put it all together, found borrower approach us. I'll touch on that a little bit later about deal flow. How do people come to us and why do they want to work with us? But this is what our investor earned, and the loan is set to get paid off, I think, on June 1st. So he's been making every payment on time since then, and that's what our capital investor earned. So what happens after 12 months? A lot of people ask that, say, well, when do I get the rest of my principal back, right? So these loans balloon. So at the end of 12 months or whenever the borrower wants to pay it off, they want to pay it off early, they certainly can do that. Sometimes there's a prepayment penalty in there, or we call it guaranteed interest. And that's going to ensure that our capital investor earns a certain amount of interest regardless of when the loan gets paid off. So that's very important. That helps a lot with deal flow and the ability to keep your capital earning and the velocity of your money to build without getting paid off too quickly and now having to find another deal to put your money into, right? So that's very important. So this was obviously a great investment for our investor. And touching quickly on just some nuances of real estate in Hawaii, there's a big differentiator between leasehold and fee simple. This is part of why this purchase price and this property was appraised at only 650. Leasehold means you don't own the underlying land. So you kind of, in different areas, you might call it land lease. In Hawaii, we call it leasehold. Basically, there's a point in time where the land will revert back to the landowner. Whoever owns the building, in our case, our borrower who just bought it, it's sitting on a landowner's piece of land and he has to pay him leasehold rent every month. But there's a point where that lease ends, and it might be 20 years, 30 years, 50 years, 100 years from now. They're usually very, very long-term leases. But in this case, I believe it was maybe 15 years out. And we're okay with that because we're lending this borrower for only 12 months. So some of the important things to keep in mind, this is how we stay creative as a lender to still find and fund good deals that still make sense for our borrowers, but still allows our capital investors to earn very solid returns and protect their principal. All right. So quickly on this page, some of the properties we lend on are going to be residential, which is typically 1 to 4 units, condotels. Condotels are common in Hawaii, where it's a kind of a hotel type facility, high rise, but you can own individual units and rent them out individually on a legal short-term basis. And Hawaii only will do land because the underlying value in a lot of the real estate in Hawaii is land. It's a very important distinction. We also lend on commercial real estate. We're a little pickier with that. We usually stay away from office. We like apartment complexes, multifamily. We like mixed use, maybe some light industrial warehouse type, but we don't really get much beyond that unless it's just an incredibly strong deal. So we like to stay in our lane, as we call it. talked about my background. So, how does it actually work as far as investing your capital? Basically, with these direct mortgage investments, now we have different channels of ways to invest. One of them I can't publicly talk about right now, but I can talk to you individually offline. Once I find out, get a better sense of your suitability and your goals and your accreditation, etc. But we basically have a mortgage fund and we have direct investments. So today we're only going to talk about direct investments. So basically, the way this works is first off, we have a conversation, suitability call. Let me understand you if you're interested, what your goals are, and let's make sure it's a good fit. And we'll run through everything to make sure that this is in line with what you folks are looking for as far as an investment vehicle. But once we have that, you basically tell us, okay, here's my buy box, here's my general criteria. I'm looking to invest 100 or 200 or 300,000 or whatever it is. And I'm generally looking for these types of deals and put me on your list. So once we find a deal, we bring it to you and say, okay, this seems like it might be a good fit for you. Here's a due diligence package. Go over any questions you have. And then pretty much you invest your capital. Once you invest your capital, it goes into our operating account. And then we assign, depending on if we already funded the loan, we'll either assign the mortgage over to you or your name or your entity or your trust will just automatically be on the mortgage if we haven't even closed on it yet. The bottom line is the funds come over, now you own the asset. The asset is the mortgage instrument. That's the vehicle that provides you the income. Now we take care of everything from, of course, putting together the underwriting package, underwriting the loan, making sure this is a deal we want to lend on, servicing the loan, which happens after closing. That's make sure the borrower makes their payments and making sure you get your deposits. So we're involved from day one before we even call you to the day the loan is paid off. Like that loan I just mentioned, that's going to be getting paid off in 2 months or less than 60 days. I'm actually personally, even myself and my controller are actively in touch with the borrower just last week, understanding that they're on time to pay it off. They understand the implications that the loan is ballooning, etc. So we're very involved with that, managing how things are progressing. So that's basically loan origination, loan management, receiving distributions. So this happens on direct mortgage investments. This happens when the borrower makes their payments, which are typically due on the first with 5 days of grace. These are normally hit, as long as the borrower makes their payment on time, these normally hit your bank account usually by the middle of the month, and it's monthly. Basically, you'll be given kind of like lender statements that shows you, okay, here's the property we've lent on, here's our annual yield, here's what we've collected so far, year to date, things like that. We'll handle all the 1099 INTs, I believe that the tax documents are. And those will go out to you, letting you know how much you've earned at the end of the year, etc. Similar to other investments. Which brings us to our next point of why we are collaborating with American IRA. So basically, who can invest? So it can be individuals investing cash accounts. You can invest through your trust. You can invest through an entity like an LLC. You can invest through self-directed IRA vehicles. So I presume most everybody is more or less familiar with how that works, but high level, it's you take tax deferred accounts or tax exempt accounts such as traditional or Roth IRAs, and instead of investing into public securities or traditional investments, you can actually place it with a custodian like an American IRA, and you are then able to control this investment in various amounts of other vehicles that allow you to explore investment options beyond public markets. So as you know, maybe gold, art, oil and gas, being an LP, a limited partner in private placements, as well as buying even real estate. So somebody with a self-directed IRA can certainly invest in this, and that's a very, very common way our capital investors invest because of the tax efficiencies. It's very, very valuable tool. I'll kind of go into how do we understand if this is a good deal or not. So I'll go into a little bit on underwriting. Basically, borrowers approach us in a number of different ways. I mean, we're very well established, so they might find us online. They might be referred to us. We might be referred by a banker who cannot do the deal. It might be a mortgage broker brings us a deal. And our main job, and I still am involved very heavily in this up front, is figuring out, tell me about the deal. What are you looking to do and why? And along the way, I have my senses out as far as picking up on What's their ability to really see this thing through? What is your business strategy sound? Is your exit strategy sound? Exit is how you're going to pay off our loan, which usually is either refinancing it, selling another piece of property, coming into some cash. And that liquidation event is going to be how you have the capital to pay off our note. But a lot of it is character. There's only so much we can look at when somebody tells me their FICO score. These types of loans, we're generally not looking at personal incomes. They're not doing traditional debt to income ratios, which is how this allows a non-traditional type borrower to, that's one of the reasons why they wanting to obtain a bridge loan like this is because of the less red tape. But that doesn't mean we just lend to anybody either. So it's about understanding, like for example, somebody's credit score might be a little bit on the lower end that makes them not able to get a traditional loan. Maybe it's in, I don't know, 620, maybe it's 600. And what I like to look for is like, not just what is the score, but why is it low? Because if anybody's been around the block before, you know your credit scores can fluctuate. Obviously, you should always try to have good credit, but there are things that the system doesn't like, which doesn't mean you're a bad borrower. So I'll give you an example. You know, maybe an investor's credit score is in the low sixes, very low sixes, but there's no mortgage delinquencies, there's no bankruptcies, there's no foreclosures, there's no deed in lieu, there's no short sales. He just happened to go a little bit over budget in trying to renovate this property himself. So he maxed out 2 or 3 credit cards, and the credit card companies don't like that. When you do that and you max it out, well, they like it because they're going to earn interest. But when they report it to the credit agencies, Equifax, TransUnion, Experian, it goes as a pretty heavy negative. So that's an example. We look at like the overall picture, not just what is your FICO, yes or no. Another example of why investors approach us is maybe the property is not in a lendable condition. It's 50% vacant. The prior landlord had issues and they just couldn't make it work. And now this investor's coming in and now they see a way around it. They're getting it at a good price and they're able to turn around the project. So most banks aren't going to lend you on a property that's 50, 60, 70% vacant. They don't like that. They want it to be already performing. So that's where we come in. We bridge the gap from acquisition or from that point to point B, and then long-term lenders will come in and take us out, which brings me to another point is we actually do long-term lending as well. That's a big part of our business. We do a lot of other loans besides these bridge loans, and it helps with understanding and qualifying for how the borrower is going to exit. So very, very important. How am I doing on time? I feel like I've been talking for a while.
Oh, you're doing absolutely fine. We've only been on for 26 minutes, so I think you have a little bit more time. You're doing great. It's very, very interesting, and I keep thinking of questions and you keep answering them. So stop being
Okay.
such a good presenter.
Are there questions coming up that I can see?
Yeah, so if you click at the bottom of the Zoom window, like where it says participants in chat, there's a Q&A
Mhm.
box, a little question mark, and you and I can see the questions, but the audience does not see it until we answer them. So right now we just have one from Burton. Great question. From a tax perspective for the investor, how is the income treated?
If you're, depending on what vehicle you're investing in, if it's just a cash account, you know, a taxable account, you can pay taxes on it. If it's in a self-directed IRA account, then of course you're either going to be, usually it's tax deferred or tax exempt, depending if it's a traditional Roth. I do have some other investors who have some complex structures where it's maybe an LLC owned by their trust, etc. Everybody's situation is going to be different, obviously, you know, goes without saying, you should always check with your accountant, your CPA, your tax advisor. If you have specific questions on how what the tax implications are going to be. But from the lending standpoint, it's simply earned income. So it's usually with these direct investments, you're receiving basically a 1099. So usually you get taxed at ordinary income rates in that example. So if it's a taxable account, right? So if it's not, if it's self-directed IRA, the interest earned will actually go right back into your self-directed IRA and you can redeploy it, allow you to compound your earnings, grow it tax-free, which is one of the big advantages.
Oh, absolutely. Yeah, that's one of the biggest things. Fantastic. This is a very good question. Latif asks, does one have to be an accredited investor to participate?
With these investments, correct. You have to be
Okay.
accredited, which the definition of that you have 200,000 income in the past 2 years and foreseeable moving forward. If you're single, if you're married, then I believe it's 300,000 or $1 million net worth, excluding your primary residence. Those are the general guidelines.
All right. Those are the two questions we have from the audience. I have a question. You may have touched on this too. What are the risks of this investment? And then what does your group do to protect the investor's capital?
The biggest risk here is that the borrower doesn't make the payments and we have to take back the property. So when that happens, the timeline can vary depending on the state that that happens in. The most effective things we can do up front are underwrite things from a technical level and from more of a personal borrower character level. That's in my opinion. Technical levels are how much are we lending in relation to the value? What kind of risk factors do we see in and around this property as far as location, the market, the economy, the demographics? Other technical factors are what are they doing with the money, right? Are we going to put it back into the property? Am I going to take it and go buy a boat, which we won't allow them to do? But it's up our job as we underwrite to figure these things out and figure out the storyline and dig into things that give us red flags. The character level is going to be, what is the borrower's experience? How do I feel their communication is from the first time they reach out to us? Are they skittish? Are they this? Are they that? Are they not communicative? Even up to the point where we are treating them at like a lead, but then we get to the point where, okay, we feel like we'll put this loan together. Here's our term sheet. Even from that point, things like how quickly are they moving too fast or are they moving too slow? Some are too aggressive in that they feel like they can get easy capital from a lender, or some are moving too slow and maybe that's a good thing. It just kind of depends, right? But bottom line is our biggest protection is our equity. So equity that it's in the deal. So our average loan to value, as we call it, is somewhere around 60% across our portfolio. So some deals are higher because they're stronger. Some deals are lower because maybe that's all the borrower needs to borrow, or maybe we feel like it's a riskier deal and we're only going to lend 300,000 on $1 million property. It depends, but that's our biggest protection. So this particular deal here is, now we mostly do first priority liens. This one was actually a second lien. And we do this on a case by case, only when it's an extremely strong deal. That's why this one is paying so much. Basically, it's paying to our capital investor 13.2%. The note amount is 500,000. It's a 12-month loan. The property value is 6.5 million. Now there is a first mortgage. I believe this one was about maybe 3 million, somewhere around there. So we were about maybe 3.5 million all in when you combine the first mortgage and our new second mortgage. And as you can see, the value of the property that we appraised it at was 6.5 million. So why did we lend on this deal? Number one, the property was owned by a luxury home builder that has tremendous experience. Why did they need the money? They wanted to basically deck out the property to make it show and shine perfectly. A couple of things evolved during their process. Number one, the baseball pitcher, great player for the Dodgers, Shohei, actually just bought a home in this neighborhood. So they felt they needed to increase the level of presentation. I hear that this property is actually listed on the market right now for 8.5. We just appraised it not too long ago, maybe a few months ago. So a couple things evolved. That was the point. That's why she needed the money. It was to really kind of refine some of her finish. The property was 95% complete already. All the mechanical, plumbing, electrical, roof is on, drywall's in. It just kind of finishing touches, a little bit of landscaping, things like that. So low loan to value, low combined loan to value, strong borrower, good credit actually, good reserves. Reserves is just how much cash do they have on hand even after we do this loan. So this deal was a very strong deal. We liked it. It was a win-win for our borrower as well as our capital investor. But like I said, most of our deals are going to be first lien positions. Okay, this is another unique one. I kind of hesitated in showing this to everybody because I didn't want to mislead them as to seeing a number like this. So I wanted to bring this up as an example. This doesn't happen all the time, but this is an example how we get creative with when we lend money. And if I happen to have a capital investor that's very flexible and say, yeah, I'll put my money in for, don't lock me up for a long time. Maybe I'll look at 6 month deals or 3 month deals. When I mean deals, I'm talking about the length of the loan. And when we do that, again, back to that point of what I mentioned earlier about guaranteed interest, this can actually become a windfall to actually juice our yields dramatically, depending on what happens. Now, there's no guarantee situations like this will happen, but the way it works is we lent this investor $640,000. She's an old client of ours. Loan to value was higher on this one. As you can see, property was valued at 800,000 when we appraised it. So we lent her actually 80%. But again, we only do this on certain situations. She was a very good borrower of ours for a long time, very comfortable, very familiar with the property and the location. So we felt okay. And it's a very short-term loan, as you can see. So we lent her $640,000. The loan was only for 3 months. She paid it off in basically one. We built into this to protect my capital investors' time and energy and ours, because we make money when our investor is making money. We make a spread. Now, this number is the net return to the capital investor. That's after our spread, which our spread, by the way, is generally 20%. Whatever the note rate is, generally we pass on 80% to our capital investor. We keep 20, and the net return, these net return numbers that you've been seeing, that's the net. So just keep that in mind. That's how we make money. So we make money when you make money, and we handle everything from start to finish. So anyway, our capital investor earned 2 months of interest on this in 1 month. So when you annualize that, it was actually a 19.9% annualized return. That's basically how it works. Now, these kind of situations, she paid it off very quickly, and we knew that was probably going to happen. Again, that's why we built in a clause like this. This doesn't happen all the time. We're not always able to negotiate these in. It is case by case, but it's an interesting way of how we can push yields without taking on more risk. That's how creative we get. I'm very involved in how we structure our loans and how ways I can make it a win-win, because my clients are my borrowers as well as my capital investors. I don't have a business without good borrowers, and I don't have much of a business without capital investors. We do, but we do other types of lending as well. But these are both my clients. I need to appease both. I have fiduciary duties, to help my capital investors and protect their capital. But I also need to be able to structure loans that the market will be open to. So that was a great kind of case study, something unique.
I think that lends the questions that are waiting in the chat, I think, are a good tie in to this. Deborah asks, do I have to fund a loan entirely on my own in order to participate? Or is there an option for you to pool my funds with other investors?
Great question. No, you do not. We structure these, that $500,000 loan I showed earlier was actually, I had two investors take 50% of that. So one investor took 250, the other one took 250. So situations like that, we can fraction it off. And our average loan size is about 500,000. Now, we don't typically like to take on capital investors on direct deals like this unless they have the capacity to invest at least 150 to 200,000. The numbers just don't make sense for us with the time, energy, and effort. So just keep that in mind. That's generally our minimum investment for these types of investments. But correct, you do not need to take on the whole note. You can take a fraction of it.
That was going to be my follow up is what's your minimum investment? So that just answered that question. George says, how is your company compensated? And I think you touched on that as well.
Yep. We make money when the loan starts performing, and we make 20% on the note rate. So if it brings in, and our average note rate is about maybe 13.5% across all of our investments, our portfolio. So on an average deal, 13.5, our capital investors are making 10.8, and then we're making 2 or 3 points spread. So the net returns that we talk about here, I try to be conservative, 10 to 12. I'm very comfortable quoting that as a very reasonable possibility. Sometimes it can be more, but I don't like to go beyond the edges. So yeah.
Anonymous person asked, what is the real estate market like in Hawaii compared to the other inland states?
Good question. Hawaii is a high cost market, obviously, based on historical trends. It's very stable. We don't have a lot of the huge ups and downs. Now we do get affected, of course, like right now, sales are down because mortgage rates are higher, or compared to, 3, 4, 5 years ago. But it's not because of lack of demand, it's more lack of cheap capital. So which we all got too used to. High cost market has different appeals. So number one, we have obviously local buyers, local investors. We have a very big presence on the mainland that likes to buy out here. Some of these high-end properties, my builders that we've done a few of, they're both from California. They've done high-end properties. There's a lot of people that buy second homes out here to get into the luxury property realm. They'll buy condos or condotels, as I mentioned earlier, which allows them to legally rent short-term rents, maybe come even stay in it, right, as a vacation. But generally, we focus in the areas where we know people are buying. We know there's some degree of demand there. There's some areas that you just kind of want to stay out of, and that's what we do. But overall, the market, single family homes, at least on Oahu, have annualized gains of like 5.5% going back 30 or 40 years, I believe. So not to knock on all of California, because it's certainly not the case for all of California, but we are like the California market. It's high price. We have high waves, but we don't have a lot of the big dips. So even going back this past 2 years, 3 years of this slowdown, if you want to call it that, sales are down, but median price homes on Oahu at least are pretty flat. So it's about million, 1.1 million for an average single family home on Oahu. These are things we're always looking at, right? What's the risk to this particular market? And it's not just overall Hawaii. We got to look at the neighborhood, certain area, the island, the city, things like that.
Yeah, obviously, very much so. And I would imagine too that per island, very similar to like the inland states, the continental states, Atlanta's different than Birmingham or whatever. But your islands have probably got to make that even more so unique to them, I would imagine. Yeah.
They each have their own feel. I mean, it's a beautiful place. It's a beautiful place to live. It's not easy for most people to make a living here, but it's one of those things that I look at it because I've lived both here and in the mainland. I understand the pros and cons, but if you want to do well here, you may have to kind of go beyond like, what are you passionate about, or really be specific about what kind of industry am I going to get in so I can earn a good living for my family, right? That's kind of the trade-off, in my opinion. That's just my personal opinion. But to be able to enjoy this environment, we pay a price for it. That's a lot. We pay my second son, who's 4, just got accepted to the same private school that my 8-year-old son goes to. And my wife and I are looking at the budget. We're like, wow, is this worth it? And then it's always to that point. It hits me, even every day too. So I understand it. I love what I do. I love real estate. I love finance. I've been in this business for almost 20 years, and my name's on the door. This is what I'm about. Very transparent, very open. I like to connect with my investors personally and my borrowers as well. We're a small boutique operation. We're not trying to get huge, but we're very focused, laser focused on what we do. And that's important to me.
Yeah, love that. I love that core value that you share. Interested of additional questions can reach out to you there, read at myerscapital.com.
Yeah, feel free to call or email me directly and we can set up a meeting and be glad to see and answer any additional questions you have offline, but really kind of find out from you, like what's important to you. And again, these types of investment, they're not for everybody. Same way borrowers come to us and they say, yeah, I want to borrow money. And a lot of times we turn them down. We're looking for the right borrowers and we're looking for the right investors because it needs to work for you as well as us. But if this type of stability, if you're either learning about or already a sophisticated real estate investor, usually a lot of people that invest with us have either done this before, lending out their own money, or they've bought and sold investment real estate, or they've had some sort of exit liquidity event, like sold a business. Maybe they're just getting out of managing all their own properties. They want to simplify. I have clients doing that, and they want to cash out on their investment properties and really just earn the income without the management. And they don't want to be in stocks, or they want a certain amount outside of stocks, bonds, public markets. That's what this is. It's just like investing. It's a continuous journey. So if you're interested in something like this, I'd be glad to be a part of that journey with you folks.
Fantastic. Love it. I think this may be our final question. How do you anticipate the market evolving in the next few years? Will interest rates change or other factors shape opportunities for passive mortgage investors?
Good question. I would counter that with how's the market going to evolve in the next week?
Yeah.
Everything is just all over the place. So obviously we have tariffs, you have inflationary events that could be stoking, also recessionary events that people are talking about. We have stagflation that economists are talking about. These are things beyond my control, anybody's control. Number one, if I do get asked this question, I know you didn't ask this, but what happens if rates drop? And mortgage rates have actually dropped. I think we're sitting at close to about 6-month lows. At least we were at the end of last week, somewhere around there. How does that affect these investments? And the short answer is it doesn't. This is the price of capital. We try to find borrowers that know about who what types of loans we're lending on, and we want them to find us. We're not trying to compete on rate. I always tell people that too. It's like, hey, you might be able to get a lower cost institutional hard money loan from XYZ lender, and that might be a better place for you. So people come to us because of their certain situation. It's a cost of capital for their situation, for speed, for convenience, for whatever it may be, why they don't work, their situation doesn't work, or the property doesn't work for a typical long-term lender. So I don't see really that changing. Yeah, things could fluctuate a little bit, but until we find where the price cost of capital overall is just, it's hyper competitive. Again, we're not trying to compete with very, very large institutions that are backed by hedge fund capital and things like that. We're very much a boutique company. And there's plenty of people, there are plenty of investors looking for our kind of capital from what I've seen. Back to your question, how are things going to evolve? One big question would be, okay, recessionary, because there's a whole trickle down effect. I was just watching a documentary this morning, or just a short blip on Wall Street Journal about the ports in LA and Long Beach, and how the trickle down effect of the tariffs coming from China. I mean, that's the busiest port in the United States. I don't know if the world, but it's definitely the busiest in the United States. And it has this whole trickle down effect of everything coming down from China, changing the amount of all the dock workers or stevedores bringing them on, and all the truck drivers, going down to all the lunch places that feed these people at lunch. And it's this huge trickle down effect. How will that affect us? Obviously, I think about demand and jobs, right? Those are two big items. So again, if we're just talking about the Hawaii market, pretty much if things start getting riskier and looking more that we need to be a little bit more delicate, then we're just going to get more conservative. And if a market just turns out to just look like it's on a downfall, we're just going to stop lending there. So I would rather be more conservative with my capital investors' money and say, look, worst case scenario, I can't put your money to work and I can't take on your investment. If I can take on your investment, that means I feel confident that I can put it to work in a safe way. That's pretty much going to be my approach. So hope that helps.
Yeah, I think that definitely spawns someone else to think of a follow-up question. What scenario would have to happen to cause my investment to be lost?
Real estate to go to almost zero.
A
Yeah.
real, like the bubble, right? Like the 2008 bubble,
Uh,
probably.
yeah, just poor underwriting. That's the beauty of it, is I don't think that it could. That's my opinion. I have a lot of my own capital in these deals as well. So just keep that in mind. Whenever we lend on, I'm putting my own money in there too. Armageddon, things that I can't even imagine.
Yeah.
It's backed by a hard asset. That's the beauty of it. And is real estate going to zero? I mean, I don't know. I guess it could. Somebody does a huge oil spill on the property and says, you can't do anything here. It's worthless. I don't know. So,
Well, you do have volcanoes.
yeah, that's lava zone 1 and 2, but not only on one island. There's only a certain part of that island that has them.
Gotcha.
Yeah.
So probably not a great investment there, huh?
Yeah.
Well, thank you so much, Reed. We don't have any more questions from the audience. Did you have any parting words or last minute topics that you didn't quite get to cover that you want to touch on real fast?
No, I think that was it. I felt like I was talking a lot.
No,
So,
you did great.
but I like all the questions, and I'm sure there's some that maybe people didn't type in. If you have any, feel free to reach out. I'd love to meet everybody here, and anything I can do to help you on your journey, I'd be honored to do that.
Awesome. Well, thank you so much, Reed. We really appreciate you being here. Thanks, Burton, for setting it all up and appreciate you hanging out too. Our next webinar is next week, Wednesday at noon Eastern. If you have any questions about American IRA or self-directed IRAs, you can reach me at marketing@americanira.com. And thanks, Reed. We would love to have you again. If you'd like to come on in a
Yeah.
few months or maybe towards the end of the year, it would be really great to chat with you again.
Okay, great. I like that.
Fantastic. Thank you so much.
All right. Thank you.
Bye-bye.